Hello, everybody. Welcome to Macro Money. This is Ilya Spivak, head of global macro here at tastylive. Welcome to the show. We have an action-packed week of macro event risk, so we're going to take it one bite at a time here. And, of course, we're going to be talking about U.S. Data later in the week, but we're going to start our conversation this week with something that is a bit more international, if you will, and focus on China. There's some critical economic data that we have right here in front of us, and what we're going to do here today is contextualize all of what's going on and how that feeds into our broader narrative across financial markets, what it means for stocks, what it means for currencies, what it means for yields and other sort of benchmark asset classes. Let's first get a sense of what it is that we're actually talking about here initially. So here's the week, and you can see, of course, toward the middle of the week, U.S. CPI jumps right out. The Bank of England policy announcement jumps right out. But today, what we're going to focus on is this, which is April's trade report from China. And what you see is, on the face of it, seemingly innocuous. Imports coming in relatively flat here, looking at expectations after falling in the prior month. Exports seen slowing from 14.8 to 8% growth year on year. The overall trade balance seen ticking down from 88.2 to let's call it 71.5, almost 72 billion, and this is in U.S. dollar terms. So the thing that you immediately see here is that there appears to be a kind of export growth orientation, which of course would be something of a change of pace for China. So at least in recent months, certainly not overall, but in recent months. So let's take a look here and see sort of what the state of affairs is and how that fits into the overall picture. This is the latest set of official Chinese PMI figures. This is from the government itself. The thing to capture here, of course, remember this is working in the same logic that PMI numbers always follow, where 50 is neutral, above 50 is growth, below 50 is contraction. The further you go above, the faster the growth. The further you go below, the faster the contraction. So you can see here the recovery from COVID lockdowns. That's right here. So you can see a very strong services-led rise. And so that's what I mean when I say that exports have not been a big part of the story here recently through this recovery, because as you can see here, it's really the service side of things, which is in many ways domestic demand, that's powering the rebound after these COVID lockdowns end. Manufacturing, on the other hand, this is in many ways China's export engine, that's down. And probably the most critical thing to keep an eye on here is that it's not just down, it's below 50. So at this point, everything has turned. In the last set of data covering April here, we have slower growth in services, but for manufacturing, you actually have contraction. And so the composite index, not surprisingly, dipping sharply lower. Here is another version of these numbers. This is the private sector estimate. The official numbers tend to focus more on large state-owned type enterprises. This one is from Caixin in collaboration with S&P Global. It's a private sector estimate, again, of PMIs. And what you see here is something that is more kind of focused on smaller enterprises and more of a private element, less of a state-owned enterprise behemoth kind of mix in the firms that are polled here. But the upshot is basically the same. You see a slowdown, you see the recovery fizzling, you see manufacturing in contraction territory, and the broad-based decline giving a meaningful pullback in the composite index. So conditions in China appear to be rolling over in a downward direction, at least over the past month or two. And manufacturing is probably the most worrying aspect of this, which of course extends directly to what we might see in trade data coming across the wires here in just hours. This, of course, is relatively lagged data here, even by data standards, as compared to what we could see in more of a real-term sense. And here we again go back to this this benchmark for kind of on-the-ground economic activity. This is something that you'll recall we've been using here, if you've been watching on Macro Money, as a kind of stand-in to gauge this reopening, because of course when China scrapped zero COVID lockdown rules, they also stopped reporting COVID cases and stopped reporting just how much of this process has actually run its course. So this is something that's a kind of immediate, almost real-time indicator of economic activity, and this just looks at metro traffic in the top 5 cities in China. What you see here is the 20-day moving average, and you can actually see the reopening, and then you can see economic activity normalize and stall. So here's the reopening right here. Here's the median through the lockdowns, and of course here's where we were before the onset of COVID. This is COVID right here. So as you look at where we are here, you can see we're essentially back to where we were before, and we're now idling. What there isn't is meaningful expansion. So one might conclude that the service sector aspect of what's going on here has ostensibly already peaked. The catch-up to normal levels of domestic activity has ostensibly already occurred. So it only makes sense then that what you're seeing is this as an engine start to roll over, and of course in the official figures as well as the private sector figures. Meanwhile, the export engine, which relies on external demand, remains significantly hampered. And again, you're seeing it both in official figures, where this is in contraction mode, and in the private sector estimate. And so, of course, then the question becomes, well, okay, so if China's domestic recovery, if the catch-up from COVID lockdowns to normalize activity, if that's run its course, so what's going on with the external sector? Why aren't we getting more of a pickup? And indeed, it's trade data that we're looking at here, very much the external sector. Well, let's consider. In the dark is the cumulative global trade turnover total. So I'm taking here exports plus imports. So just looking at overall volumes. And you can see that as Fed rates start rising, the kind of dampening effect that a higher cost of credit would have on economic activity, or one would expect, to occur is exactly what you see. So we've talked, of course, here before about the dollar being the ubiquitous global medium of exchange, and what the Fed then has embarked on being something that increases the cost of doing business, not just in the US, but internationally, in that it makes the dollar, which is the transactional unit of global commerce, more expensive to borrow. So this then becomes a form of tightening, not just in the US, but everywhere. The cost of credit then becomes more expensive. The cost of financing economic activity becomes more expensive the world over. And so what you then see is with that rise in rates, you likewise have a pullback in global trade. What you also see, these are numbers from the IMF, they're a bit lagged. They get up to January here. But you can see that Fed rates, of course, continue to move higher. And so you would expect that there is still more weakness in global trade that is yet to be reported as the data catches up, if this inverse relationship from the beginning of last year continues to hold. Now, here is how China fits into that story. What we have here is a sense of China's share of global exports and imports flows. So the top line there is the share of global exports that belongs to China. You can see, of course, it vastly outstrips the share of global imports that pertain to China. And so you can see here very clearly that the world's largest economy is primarily dependent on external demand for growth, because its share of global exports is so much greater than its share of global imports. It's essentially one way of saying what the world's second largest economy is primarily powered by is not domestic demand, imports, but external demand. And here you then have a significant issue, because if what's going on is that external demand is being slowed by Fed rate hikes, then China is uniquely exposed. The other thing that you see here is that the share is actually trending lower on both fronts. So what you see is a kind of generalized deceleration. Now, in the case of exports, you can see it's still arguably normalizing to levels before COVID and the subsequent normalization. The dotted line there is just a 12-month moving average, and you can see even there, it's well above where that average was, let's call it, in 2019. So we're still normalizing, it looks like. We're still trying to get back to a kind of normal, similarly for imports. So China's share of global trade flows has certainly been edging lower, but not in a way, perhaps at this point, that would suggest that its importance in powering global growth has diminished. And this is a key part. This suggests that we still very much care about China's contribution or lack thereof to the global business cycle. This gives us yet another perspective on this. What we see here is that global trade as a whole is shrinking, but global trade with China is shrinking much faster. The blue line here is total global exports and imports, and then we're looking at the year-on-year growth rate there. And same for China in isolation for the red line. And we can see here that China, as a percentage of global trade overall, is represented by the yellow bars in the back. And you can see that since the surge after initial post-COVID reopening, where China was, you can see here, 15% of overall global trade, exports plus imports, we've now come down to about 12 and a half. Not the lowest it's been recently. We've gotten as low as 11. You can see during the height of the lockdowns, but certainly down a bit. And really the eye-catching part is that Chinese trade in year-on-year terms is shrinking at this point at nearly 15% year-on-year. Whereas overall global trade, while also shrinking, is only shrinking at about 1.2%. And that is quite a sobering statistic for an economy that we can just that we've just seen, looking at the data that we've just looked at, is dependent on global demand, and which may be running out of domestic catch-up in economic activity to keep it powered. Indeed, here is a look at China where we take the share of trade as a percentage of GDP, and again, not net exports, but cumulative trade volumes. So how important is overall trade in the sum total of the size of the economy? And you can see that with the lockdowns, of course, we had a sharp decline from 41% to 34%. One might expect that, since this is data that runs only through the end of last year, that number has already come back, because of course we've had those lockdowns lifted, and there's since been, as we've already saw, a significant pickup in economic activity. But the trend, you can see, is nevertheless toward greater reliance on external demand. You can see there, I've put a trend line that approximates how this has developed, and it's very much pointed higher. So China has only become more dependent in recent years on external demand, not less, even as it's attempted to make the case that it wants to go to a more consumption-led growth model. Looking at overall economic data out of China, we can see the reopening there. We can see that economic surprise index that we like to look at, that tracks the performance of economic data relative to baseline forecasts, and goes up when the data outperforms the forecasts, goes down when it underperforms. You can see it appears to be idling. So there's that sharp catch-up at the reopening. You can see it occurs right as we get into the beginning of this year. Here's the reopening right there. You can see here's that catch-up in economic data. And now it looks like we're maybe starting to idle a bit. And maybe momentum is starting to be lost. If this is in fact the case, at the same time as we have loss of domestic demand, and increasingly a concern about recession, these trade numbers that we're going to see today could in fact be quite reactive. Because what they then speak to is an important gathering headwind for global growth that till recently was actually thought to be a tailwind of sorts. You'll recall that China reopening and the idea that the world's second largest economy had all this pent-up demand that was going to come online and power the global economy, even as everywhere else was in large part hampered by tightening, be it Western Europe or, of course, the U.S., and even more broadly North America, because, of course, we've had significant tightening in Canada, significant tightening in and across the EU and even former EU. The UK has certainly had quite a bit of tightening. Japan is really one of the few places in the G10 and in the sort of major top 10 economies mix that hasn't had meaningful tightening. And of course, neither has China because of these lockdowns. So what we're looking at then is an environment where you have now perhaps the hope that China's reopening would have created an offset to that tightening starting to actually turn inward and become the concern that the absence of a lasting bit of support there, the reopening's belated arrival with global demand already beaten down by a year's worth of Fed rate hikes, that the dividend from China's reopening never really arrives. That you have a bit of an episodic bit of support from domestic demand, but if that's fizzling, and the evidence from the trade data on the external side jiving with manufacturing PMIs below 50 suggests that the export engine is fundamentally hampered. And the reason it's hampered is because a global tightening has taken away end demand by a significant margin. Then what you're looking at is recession, really gathering the fuel it needs and waiting for a spike to begin raging. We know that the markets are increasingly concerned about recession because of what we've been observing for a couple weeks here. This is the relationship between the S&P 500, and I bring it back here really as a benchmark for market-wide risk sentiment, and I overlay it with the outlook for Fed policy rates by the end of the year, as implied in Fed funds futures, as, again, a kind of catch-all for global tightening, because as we've said here today and as we've said on Macro Money many times before, it's the Fed driving global tightening because of the ubiquity of the U.S. dollar. Other central banks are, of course, doing a degree of tightening themselves, but yields moved in anticipation of the Fed long before many of these other central banks joined the party. So what we're looking at here is really the evolving relationship between risk sentiment and global tightening. And what you see is before the SVB episode, here, as you have building hawkish expectations for policy, you have a negative response from risk. There is a sort of shaking up of the Etch-a-Sketch here with the SVB and related banking crisis fiasco. You since get a rebuild in risk. Notice the S&P is about where it was when all of this started to occur, back to about the 4,200 level, give or take. But rate hike odds never really rebuild. They never really come back here. And what you notice is there is now a difference in sequencing, where here, things becoming more hawkish was bad for risk and vice versa, whereas what we're seeing now is that they're moving in tandem, which no longer suggests that we are in an environment where the markets are going to be enthused by bad data because that means less tightening, say, but instead are focused on why would the Fed outlook get soggier? Probably because of slowing global growth. This is probably bad and heralds some sort of downturn. And so risk has started not to take solace from such things, but actually to move with it lower. And indeed, this works both ways. consider what we saw on Friday with that NFP report that actually turned out a bit more positive. What was the response? Risk was up. Aussie dollar was up. So S&P higher. This is that jobs report right here. S&P up. Aussie dollar, which we've talked about as a kind of barometer on global growth and on overall risk sentiment, as well, by the way, as a barometer on China, because it is China that's Australia's largest export market. That's up. Dollar steady for the most part, a bit higher initially and then lower. Now, give or take steady. Yen, a creature of yield, as we've discussed here, lower. Bonds down. Gold down. So all of this really breaks down to, here was a good piece of data. Yields went up. That would be how the yen, bonds, and gold are lower. And in that environment, risk improved. That would be how the Aussie and stocks are higher. So that's good data being good for markets. And of course, the flip side is if the data were bad, that would be bad news for markets, as we see here. Sort of general trajectory for where this is going. Which tells us that indeed the market seems to be less so inspired in the way that it was over the 18 to 20 months before SVB, where good data would be bad news because that would mean more Fed rate hikes, and bad data would be good news because it would mean fewer of them. Now, it is the actual business cycle that seems to be the object of speculation, not necessarily the Fed's next move. And with that, something like Chinese import and export data that points to deteriorating Western demand, which is exactly what that would be a window into, as we see here now, speaks to recession risk perhaps deepening and showing us something that labor market data, as we saw it on Friday, maybe hasn't captured yet, lagged as it is usually. And so this data may well be something of a canary in the recession coal mine out of China today. And to that event, if in fact it performs worse than expected, and if in fact it gives us this recessionary spook, the response, one might surmise, would be the opposite of what we see on the screen here. Stronger gold, stronger bonds, stronger yen, weaker stocks, certainly a weaker Aussie, and perhaps even a stronger US dollar in the event that it finds, once again, some of that liquidity-driven haven demand. And that is Macro Money for today. Thank you very much for joining me. I'm here Monday through Thursday, as ever, after overtime with our good friend Chris Vecchio, head of Futures and Forex here at tastylive. I'm also on with Chris on Fridays for Futures Power Hour, and then on with Tom and Tony for First Call on Sunday evenings. Outside of those shows, I'm opining on Twitter at Ilya Spivak. Good luck out there, everybody. We'll see you tomorrow for a conversation about US CPI. Take care.